Rate cuts and AI optimism have been pushing stock markets to new highs. But what are the potential downsides? What about possible pitfalls here? Which sectors and stocks look the most promising? We are joined by David Burrows, President and Chief Investment Strategist at Barometer Capital Management. David, great to see you. Thanks very much indeed for joining us. What's your feeling? Is there euphoria in the stock market right now?
Look, it's interesting, Andy. If you looked at the list of risks, there's some obvious ones that people are concerned about: impact of tariffs and geopolitical risks and so on. Probably sentiment is one of the bigger risks because certainly there is optimism. But, at the end of the day, we have to take our cue from messages coming from the market. And in general, the message is pretty positive. We have banks basically trading at new highs. 100% of banks are trading above their long-term moving averages. And if you look at all of the times in history when the Fed cut rates, if banks were trading at highs when it happened, it's a message that investors are reasonably confident. And when that has happened in the past, it was that markets continued to be favorable for quite some time. So realistically, the message from the market is, yes, people are optimistic, but it looks as though there continues to be money being put to work and there's opportunity.
Inflation, you reckon, is the biggest risk here to the stock market, I guess you mean, among other things, David?
Well, in fact, what I mean is the biggest risk to investors is inflation. So when you think about the risks that we have to deal with in portfolios, realistically, the risk that inflation eats your money is the stick that says to investors, you need to invest so that you can protect yourself from losing purchasing power. Money is working its way into equities. Many companies are a great hedge against inflation because they have the ability to raise price if their costs go up. And if you can get a rising, stream of dividends from your equities, that's protecting you from a rising cost of living. When you look at what's happening in commodity markets, it started with gold, and gold has been a juggernaut for the last 18 months. But we're seeing strength in copper. We're seeing strength in uranium. We're now seeing some early signs strength in energy, which has been notably absent. And so those things also would say, it's likely to be a more inflationary environment. And again, those companies, the producers, benefit when there is inflation. And so as an investor, you protect yourself against inflation by owning some of those producers.
It's interesting you mentioned copper because it did go up today, and that's after Freeport-McMoRan warned that it may not be deliver copper as contracted from its huge Grasberg mine in Indonesia because there's been a cutback in production after 2 workers were killed and 5 others went missing in an accident. So copper has moved higher today. Of course, that's just one day. You've been focusing on international equities. Where do you see promising areas there, David?
Yeah, depending on which area of the world, 15 to anywhere to 30 years in Japan, global stocks or international stocks outside the U.S. did not perform for a long time, and the U.S. was the only game in town. And over that long period, global investors bought a dollar that was rising versus their currency and bought the U.S. stock market, which was outperforming. And arguably, probably after 15 years, most global investors are sort of maximum long U.S. stocks. Global stocks trade at much lower valuations, partly because of the sector makeup of the all-world index. But valuations are really favorable. Fiscally, governments are spending more money. The commitment to spend more on defense, is stimulating things. And in the last 6 months, the rate of change on the MSCI World Index is in the 90th percentile of all occurrences. So when you get a surge in performance in global stocks, it tends to be that's the beginning of something, not the end. So there's very good reason for valuation purposes. There's also very good reason because the global market, like 31% of the MSCI All World Index is financials. Financials benefit in the environment that we're in, where short rates are low and long-term rates are high, and they make a net interest margin. So we think that for global investors, there is now incentive with their local currencies strengthening and their local market outperforming the US market for the first time in many years to slowly repatriate assets back to their local markets, such as Japan or European markets or even South American markets. And so from a risk reward perspective, isn't it great to be able to have another bucket that we can focus in and add diversification to portfolios?
Seasonality. Apparently, the second half of September can be particularly rough. What are your thoughts on that, David?
I mean, if you just look at a seasonality clock, the last 2 weeks of September have historically been the worst 2 weeks of the year. And that's a bit of a crude tool. The truth is, when you've come into that time of year with markets on a good footing, it tends to be actually the rest of the year winds up being particularly strong. And when we look at market breadth or the percent of securities performing well, it has been rising in almost every major global market around the world, including the US. And, we have 100% of banks trading above their 200-day moving average. 95% of semiconductor companies are trading above their 200-day moving average. Two very economically sensitive groups. So often analysts are cutting their estimates at this time of year because they've been too optimistic early in the year about their expectations. This year, analysts cut quite aggressively in the spring after the tariffs were announced. And now we're seeing estimates go higher. So it looks as though estimate increases would support money getting put to work and valuations not being quite as high as what people thought.
David, always great hearing from you. David Burrows, President and Chief Investment Strategist at Barometer Capital Management.